If you guys are ready, I'll. Okay. Okay, hi everyone, and welcome back to Tech Talk. My name is Jordan Wong. I'm a portfolio analyst on the Investment Products Advisory Group at RBC GAM, and of course, as always, I'm joined by Marcello Montanari and Rob Cavallo, both portfolio managers on our Toronto-based North American equity team, and responsible for strategies like the RBC Life Science and Technology Fund and the RBC Global Technology Fund, as well as a number of other growth-oriented investment strategies. Now, if you're new to the program, we get together once a month, talk all things technology and healthcare related, highly innovative, dynamic, and fast-paced sectors. So we think it's just a great way to keep you all up to date and informed on what's going on across these sectors. Marcello, Rob, welcome back.
Thanks for
Thank you.
having
All
us.
right. So it's kind of funny, right? Like I think we've talked about this for a little while, but we figured at some point we would get to a state where it would be time to talk about whether or not we are in a tech-related, AI-fueled bubble similar to that of the dot-com era in the late 1990s and early 2000s. So that's really where I want to kind of focus today's episode on. Of course, if we have time at the end, I think it'd be great to touch on recent antitrust settlement between Apple and Google and what the implications are for both of those businesses. But maybe if we kind of start on this AI bubble related topic, there have been growing calls from investors, economists, business people that we are maybe entering a bit of a tech related bubble. I think, based off of a lot of what I'm reading, a lot of comparisons made to the dot-com bubble in terms of really elevated valuations, a high degree of market concentration, in particular across the top 10 stocks in the S&P 500. At the same time, though, we're seeing, a tremendous commitment to CapEx and revenue growth, earnings growth that far outpaces what we saw during the dot-com bubble. And so maybe to kick us off, walk us through kind of what you're thinking in terms of whether or not we are in a bubble. What are some of the factors that you're looking at, and if you can kind of compare contrast where we are today and where we were in the early 2000s, I think that would help us kind of all better understand where we're sitting at today.
Maybe I'll start. Are we actually going to do this today? It's like today, I guess because this will be posted later. Today's what, September the 10th. Oracle last night just reported basically they have signed contract values a total 455 billion. That's billion with a B. Microsoft just signed a deal with a small kind of neo cloud called Nebius for $10 billion. TSMC, I think, just put up some pretty good monthly numbers, Rob, if I'm not correct. So I mean, the technology seems to be moving forward, and I know that Sam Altman, was on a news program, kind of mentioning that he thought that we may be in a bubble. I think it got kind of misconstrued as we are in a bubble. I think he came back after and kind of made some clarifying comments about it. And he said, I think he was really more focused on the kind of the exuberance of markets, which is important to us, obviously. But, when he brought it back, he said, the technology is not a bubble. It's probably I think he said it's like the biggest thing that's happened in his life technology wise. But I mean, it's definitely on par, if not exceeds, the development of the semiconductor and the internet and mobile for sure. So, I guess I was at the first bubble, the first tech bubble of the internet. So, what I could tell you is it's very different. It's very different. I coming back to Altman's point, like the technology itself is not in a bubble, but there is some exuberance. The tech is very real, and it's early. The usage appears to be exploding. Like Google, Sundar on the last conference call said that in May, like we measure the usage by the usage of tokens. Google used 480 trillion tokens in the month of May, and at the end of July, it had jumped to 980 trillion tokens per month. So you could see that it's growing. If you follow the sector at all and you listen to some of the people who are deeply involved in it, um, every time capacity comes on, it gets used up. Um, and because of the usage, like this is obviously feeding the capex, and I'm sure that Rob will have some points on this after. And the capex is kind of getting raised, every quarter. And obviously, we can add Oracle to the list because last night they raised capex by at least another, I think, $7 or $8 billion for this year. Um, so the capex is real, but what is different from this bubble, from this period versus the tech bubble of 2000 is, the capex is underpinned by companies with real revenues. These are the biggest companies on earth, um, with real revenues, real earnings, real cash flow, and they're the ones who are predominantly driving all of this, at least at the moment. So that's in contrast to back in the bubble where there was all these new companies coming out, and most of them were basically funded by the market, and didn't really have businesses that were self-sustaining at that point. So the funding for all of this is like in very strong hands, and to me, it looks like we're still kind of in the early innings of this. I mean, I don't see any sign that it's going to change. Rob might put some additional color around that. Um, the valuation issue is, like, having lived through it, like it's very different. Like the valuations for sure in some areas is getting stretched. I should go to another spot first though. Um, where when we talk about a bubble like an exuberance, what we tend to have when you get a whole new ecosystem is you get this process which is coined by Michael Mauboussin called fill and kill, which is you get speciation, that basically all these companies or these species, whatever, they put their hands up and say, "Hey, I'm an AI player. I'm an AI player," um, and a lot of these are just pretenders. They're
Mhm.
really not going to play a role in all this, but the exuberance kind of, they can take advantage of this exuberance and be recognized as, oh yeah, maybe they are an AR player, and as a result, capital flows their ways, and the stock prices. Some of these stocks become, I'm not going to name names, but some of these stocks become meme stocks and they have big runs. And so I want to differentiate that, that's not the game that we're playing. We're playing with the bigger names that we think have a true claim on this technology cycle. So eventually these fill and kill cycles, as you fill the entire ecosystem with all these players, but the market ultimately won't support all of it, and there will be a culling at some point. So that part. So is there a bubble on emerging in some of these areas, like on the fringes? I would say, yeah, there's probably some of that happening for sure.
Mm.
But in terms of like the big central players to this, I think we're still okay. So like now coming back to the valuation, like some of the, like I said, these fringe players, the valuations on these things, I haven't really looked at them, to be honest, because a lot of them to me just don't make sense. But um, they're the valuations there are probably like nonsensical. Um, and in the names that we're playing, for the most part, yes, valuations have definitely have stretched a bit, but they're not like crazy. And they're certainly not like the tech bubble of 2000. And they're based on like real metrics. They're based on real earnings. They're based on real cash flow. They're based on EBITDA. The younger the company is, it might just be on revenue, but at least there's something there.
Mhm.
Back in the bubble, like things were being valued on uh, price per engineer, price per PP&E, price per fiber root mile of the fiber that was being laid, price per page view. It was like there was all these crazy metrics that made absolutely no sense. So that's a very different situation than what we have now. So uh, yeah, I'll just like on
And maybe,
valuation, I'll just kind of leave it there for a second.
yeah.
And at the same time, and I'm sure that Rob will opine on this as well. Like we've been pretty clear that you know at some point we're going to get we're going to get some pullbacks here and there. We're going to have stocks that are going to mark time as we try to digest things, and things don't just go up straight up in a line forever. They'll take some pauses here and there.
And sorry, maybe just before we move on to Rob, Marcello, earlier you'd mentioned capex. Are there concerns at all on like the ROI related to capex? Right, like we're reading that capex is totaling close to 600 billion. AI related revenue is still a very small fraction of that. Is this just something that we expect to kind of pay dividend later on?
Yeah, I mean, for the most part, there's some companies that are using AI and machine learning right now to
Mhm.
basically improve their operations, and those are the usual suspects, and they're the guys who are spending the most money. Whether it's like Meta and it's Google, they're using it to basically drive all of their search algorithms and their and everything that basically that serves up ads at the right time to the right person. So that's all being run by AI and machine learning. So those guys are already starting to get results out of this. Microsoft and AWS are using it for Azure um, sorry, it's Amazon AWS. Um, they're using it to basically, offer services, and they're starting to see just in the last quarter, the things started to kind of inflect upwards in terms of their revenues. So I think for some names, just because the spending is quite big here, and the cost to create these models has been quite large for at the frontier at least.
Mhm.
So it takes time. If you build a dam to generate power, you can't expect the ROI on that, and before the dam is completely opened. So
Right.
I kind of liken it to something like that. In a lot of cases, it's kind of build it now and they will come sort of thing. I hate to use that, um,
No, that's great.
there is an expectation that businesses will be built off of this. But so to expect an ROI like today for a lot of these is a little misplaced.
Nope. That's great. And Rob, maybe just jumping over to you, kind of related to this AI bubble question. You cover the semis. We just had quarterly earnings from NVIDIA and Broadcom, two key players in the AI infrastructure build out. There were some pretty significant takeaways from these earning releases, particularly comments around committing 3 to 4 trillion in capex by 2030. So maybe just walk us through what you took away from both NVIDIA and Broadcom earnings.
Yeah, thanks. And while I answer that question, I'll kind of actually add a few points to the prior
Totally,
question just about the bubble. But
for sure.
for context, Sam Alm had made those comments, and now it's rumored that they've actually taken up their cash burn profile from by $80 billion over the next
Yeah.
4 years. So they actually are, there's rumors that projecting about 35 billion in cash burn in 27, 45 billion in cash burn in 28.
Hmm.
So I mean, there's a little bit of self-serving talk in what he's saying. But I also think taking the lesson from 2000 is that there was a tech bubble and there was a telecom bubble. The tech
Right.
bubble you can liken to sort of the meme, the metaverse bubble of 21, 22. It doesn't have huge tentacles across the entire market.
Yeah.
Maybe as part of the venture ecosystem, yes, but not for the broader market. The bigger problem in 2000 was the broadband bubble, the telecom bubble, and that's kind of like what the capex bubble that people are talking about today. Big difference. So you thinking about, I mean, you never say never. You never know. You never know that you're in a bubble until after the fact. So, grain of salt with what I'm going to say. But you look at Cisco as the poster child in 2000, trading at well above 100 time forward multiple. The market is basically saying there's a very, very long tail, and we don't foresee any problems indefinitely for what the spend is going to mean for Cisco's business. You look at Nvidia today, trading, at albeit 40 times calendar 25, but 20. I think they're trading at like 27 or 28 times today, next year earnings. And there's still this huge wall of worry about 27 and further spending. I think the market's okay with 26 spending is going to be from a capex perspective, but for Nvidia, Broadcom, and the rest, there's still this wall of worry. And I think it's still, as long as there's this wall of worry, um, and the evidence is suggestive that the capex obviously is going to slow down. There's a deceleration in the growth rate, but the absolute dollars are still going higher based on what we can see next year, and probably still in 27, 28, especially when you listen to comments from Nvidia and Broadcom most recently, and Oracle, what they suggested last night. So there's still this wall of worry
Yeah.
and a different valuation level that, like, this is may not be able today. But if it is, it could get much crazier before we get that first air pocket. But based on what we're seeing today, based on product cycles, again, comments from management teams, and parsing together other pieces of information across the industry, like we don't see a break in that spend yet in 26 or 27. You get obviously beyond that, its visibility starts to get very difficult. Um, but clearly we don't see that break in the capex cycle just yet. Broadcom CEO, for instance, just signed on to stay for another, basically to the end of the decade, and his pay package is going to be, for better or worse, completely tied to AI revenue that Broadcom's going to
Yeah.
generate. And so Broadcom this year is going to do about 20 billion in revenue. Suggested to do a little bit more than 40 billion in 2026. His pay package is going to pay him his payout of 100% of his payout is based on 90 billion of revenue, so more than doubling in, what's that, 3 fiscal years, with the high end of it being a quadrupling almost of revenue. Excuse me, slightly less than a quadrupling, but basically going from 40 to 120 billion. So this could get much bigger before we see any sort of doom around what that spending environment looks like. And then it's going to come back to your ROI question. If the ROI profile is there in 3 to 5 years, and this truly is transformational, both from a cost savings and from a new vertical or new market expansion opportunity, like spending can go on much longer than we all think, and what the naysayers and doomsday sayers want to say at this point. So we got to be smart and selective.
Yeah.
Try to stay away from areas that maybe are more susceptible to competition, susceptible to a margin profile that might not ever catch up to the revenue profile. And that's where we're trying to be, diligent and responsible. But we still see, growth on that spending, at least for the next couple of years.
Yeah.
And then beyond that, we'll have to wait and see. Just keep updating our views.
Well, maybe we'll have to do another episode on this sometime in the future then.
I'm sure we will.
Perhaps not the last time we talk about this. Maybe just pivoting ever so slightly. I do want to talk about this Google Apple, I guess, antitrust court ruling. Maybe just walk us through the verdict there and what it kind of means for both of these businesses. Since the verdict released, both stocks shot up. Google's continued an upward trend. Apple's kind of fallen back down. So maybe what's going on between these two, and how are you feeling about this this court ruling?
Yeah, it's more the remedy stage here.
Yeah.
The verdict was already rendered that Google was running kind of a monopoly here. So so this was the remedy stage, and all you have to do is kind of look at the stock prices to see how how it's been interpreted. Essentially, as one person put it, it was expected that it might be a clearing event, but there was some pretty draconian outcomes that were kind of in the cone of uncertainty here. There was some pretty draconian outcomes that gave people pause and everything. So it basically became a clearing event, and the remedy was viewed as being kind of a slap on the wrist. And one person said, "Yeah, a slap on the wrist with a feather." So essentially. Just to really summarize it, Google doesn't have to sell Chrome, doesn't have to divest of Android. Apple has been Apple is allowed to basically sell access to through their operating system. That's been kind of whittled back to the contracts are only allowed for a year. And right now it looks like Google's going to basically be hanging on to that. And as a result, a headwind has just been kind of removed from the entire sector. For Apple, it was Apple's probably looking forward, they're probably going to be in a pretty good position, because at some point they'll be able to kind of maybe not auction off, but to use their leverage to get better terms out of other search engines, whether it be
Mm-hmm.
Google or somebody else. So that's I'm thinking more kind of second derivative, because at the moment I don't think anybody's in a position where they can actually displace Google. Like Google's just the amount of money that Google pays Apple here is just too big, and I just don't think
Yeah.
that. I mean, I could be wrong. I don't see anyone displacing them in the short term. Um, like I've said to others, I said there's there's a difference between the desire to take this business and the ability to do it.
Yeah.
Google has all the infrastructure enabled to carry this traffic and to basically process all of this. And as now as we get more into like AI overviews and things like that, like the amount of processing this is taking has to be going higher. And maybe that's why, as I mentioned earlier, the token count is just like exploding at Google. So there's not many other players that can do this and take this type of a risk. So we'll see how this plays out. But in the meantime, you know, Apple gets to keep its keeps its gatekeeper status, gets to charge for it, and Google at the moment is going to continue to do that. I guess they're going to sign 1 year contracts rolling forward, and maybe they could be displaced at some point. What's more interesting is probably the second derivatives, because
Yeah.
other players are now going to start to kind of reposition themselves. I think it's probably likely that at some point OpenAI is going to launch some sort of an advertising-based approach to everything. So they get I mean, they need to get more revenues, obviously, and search and advertising is certainly going to be. I would think that they're going to be doing that. They hired a pretty key person from Google, so something's going on there. So that'll probably be a bad headline for Google at some point in the past, in the future. Um, but all the players that are involved here, whether it's Bing or OpenAI or Anthropic, like I think they're all going to be, trying to reposition themselves in this new landscape where Google could at some point in the future, uh, you know, be at least lose some of its position within Apple. But at the same time, there was an article in Bloomberg that Apple and Google are talking about making, kind of Gemini. I don't know if they'd call it Gemini at that point, but Google would be the AI engine
Right.
for Apple, because Apple's AI efforts seem to be faltering. They're in a great position because they're the gatekeeper, but their efforts so far haven't been that haven't been that remarkable. In fact, it sounds like it's been marred by all sorts of controversy and everything. But so we'll see. The second derivatives are going to be pretty interesting going forward. And I think, as we've seen, Google has continued to rise, and Apple has been kind of coming off. And I think that's just because Apple had their unveil of the new phones and stuff yesterday, and they were a little underwhelming. So I think that's
Sure.
kind of hitting the stock, today and yesterday a bit.
That's great. Rob, anything from you before we close out the episode?
No, I mean, I think you touched on it. There's obviously rumors of Apple doing some sort of big M&A potentially to get themselves in the LLM game, but clearly this kind of changes and solidifies the fact that they can kind of provide the network or the ecosystem and let
Yeah.
the others fight for it. And then you mentioned Google and Apple working together and from an AI perspective, but I think it's also important just to also flag the rumors around Siri potentially
Mm,
being powered by Google Gemini and some of the upside opportunity that might be for Google now that this
Yeah,
hopefully is coming to some sort of finality.
yeah.
perfect. Well, thanks, guys. That's all I wanted to cover off today. So maybe we'll end the episode off here. As always, really appreciate you sharing your insights with me and all the people that tune into this program. And for those of you watching, if you would like to learn more about some of the strategies that Marcello and Rob manage, strategies like the RBC Life Science and Technology Fund and the RBC Global Technology Fund, it's best to visit our website, rbcgam.com. And I will mention before we sign off, we are now on YouTube. So all of these episodes that we'll be recording are going to be posted to the RBC YouTube page. We'll make sure to put a link somewhere in the description down below in case that's an easier way for you to stay up to speed and stay current with the episodes that we're posting. With that, we'll end things off here, and we'll be back next month. Thanks, everyone.
Thanks a
Thank
lot.
you.